disappointing stock returns to come in the next 10 years. Now I'm going to prove it right here. All right. So I'm reading every weekend, every Sunday. My man Meb Faber sends an article out, just stuff he's reading, and I like Meb, so I like to see what he's reading, and I like to read it myself. And here we got an executive summary from AQR, and my man Cliff Asness over here runs AQR. I don't know these other guys, but I've been reading AQR for a long, long time, and this is an article: Driving with a Rear View Mirror. Will we see a repeat of the past return decade of the U.S. equity returns? And this guy, Jordan Brooks, says, I decompose U.S. equity market excess of cash returns into 4 components: dividend yield, real earnings growth, multiple expansion, and the real return on cash, to analyze what assumptions investors need to have about the next 10 years. All right. And he actually adds a 4th component. So John Bogle from Vanguard, Jack Bogle, he always said dividend yield plus earnings growth plus minus PE contraction or expansion. But I like what Jordan is doing here. He's using a real return on cash as a 4th component to that equation. I actually like that a lot. So what we're going to see here is we're going to go to 1950 to 2023, and we're going to see what the components of U.S. stock returns were. This is real, net of inflation. Dividend yield was 3.4% from 1950 to 2023. That's the average, what we've had for dividend yield. Earnings growth was only 2.6%. I was very surprised by that. That's e.g. earnings growth. Again, that's net of inflation. When you factor in, I was just reading the other day about the guy who developed the integrated circuit. I forgot his name off the top of my head. Kirby or something like that. I just forgot. He was battling with another guy from like Norcon, or I can't remember. So this guy's from Texas Instruments. The other guy's like the CEO of, I almost say Norcon, I just forgot. Very interesting, because before we had all these vacuum tubes and whatnot to run a basic software program, a computer, and they were trying to deal with the tyranny of numbers, and they came up with the integrated circuit, and it's amazing what has happened technologically. This right here, it's insane. And then on top of that, we have fracking, the development to be able to extract oil and natural gas from previously unachievable things in the ground. And, all the idiots on peak oil and all this stuff, we've had abundant coal, abundant oil, abundant natural gas. We just have to get to it, and we can, because of George Mitchell and the boys who developed hydraulic fracturing, or you want to say horizontal drilling, if you want to say that. Either way, it's fracking. And as such, we have abundant. In fact, if you look at the exports that U.S. is doing since fracking was solidified, we're exporting natural gas and oil like is going out of business. It's crazy, man. It's awesome. We're a freaking powerhouse in that regard. So when people say, we're not doing anything here, well, they don't know what the hell they're talking about, because we're exporting massive amounts of energy supply. That's just a fact. So, and that was all, and that's interesting that we still, in real earnings growth has only been 2.6%, even with all that factor in. It's crazy when you think about how abundant our lives have become. And it's freaking wonderful to behold. I love it, man. All right, so we got the old days, 3.4% dividend yield, 2.6% earnings growth year over year. Price to earnings expansion. I mean, it grew, the PE ratios grew by 1.8% on average each year. Again, it's not a linear thing. It goes up and down, but on average, if we started with a PE of 8 in 1950, it grew by 1.8% a year to what it is now, like 30 or something like that. So price to earnings expansion. Now, this is a little bit counterintuitive. This is your cash returns. Were you rewarded or penalized for holding cash? In this case, you actually made money in cash relative to inflation from 1950 to 1973, right? You actually made money in cash. That meant your cash was paying, your savings accounts and whatnot was paying more than inflation. So that's a headwind for stocks, because you're being rewarded to hold cash. You'll say, hey, I got some cash. At least I'm making net of inflation. I'm making money. That'd be money I don't want to put in the stock market. All right, so that'd be a headwind on the stock market. So all these 4 things combined, we averaged 7.1% real return on stocks from 1950 to 2023. The last 10 years have been completely different. We've averaged 11.9%, significantly higher than this, 11.9. And the first thing that jumps out at you is the dividend yield has gone down from 3.4 to 2.1. Why? Well, because we're doing all these buybacks or share buybacks instead of paying dividends. All right, so the share buybacks, we're taking the cash, instead of paying the dividend, we're buying back the shares. So that reduces dividend yield. All right. Obviously, and on top of that, what else reduces dividend yield? Price is going up. All right, so an increase in PE reduces dividend yield too. And we've had a massive increase in price to earnings ratio over the last 10 years. It's averaged 3.8% a year over the last 10 years in terms of PE expansion. And that, I don't want to say record highs, but we're certainly in the nosebleeder seats when it comes to price to earnings ratios. Interestingly enough, earnings growth, earnings per share, if you will, has grown significantly higher than it did in the past. Even though dividend yield went down, earnings growth went up. And the reason for that is simple. It's because when you're buying back shares, you're taking off the number of shares that are open out there in the market. So your earnings per share is going to go up inherently because there's less shares, if that makes sense. You're reducing the supply. So the dividend yield drops because we're not paying as much money into the dividends. On top of that, the prices are going up because the earnings per shares are increasing because of dividend yields. So dividend yields are low. Earnings growth is higher because we're taking away shares, because it's EPS, earnings per share. And then PE ratios are going up as well because people are like, oh man, your earnings per share are growing faster than other sources of bonds or something like that. So I'm going to buy your stock because I can get a higher earnings per share. Which does what? Makes my PE ratio go up, and it reduces dividend yield. All right, so dividend yield is only 2.1, but earnings per share has grown by 4.5% a year. The PE ratio has also grown. These all factor together by 3.8% a year. However, we also got the advantage of having negative returns on cash. We were losing money in cash if you held in cash over the last 10 years, which equated to a net return, a tailwind for stocks. Because cash was paying a negative return, people are like, oh man, I got some cash. I don't want to lose to inflation. And I still got to pay tax on it. So what I'm going to do is I'm going to put it in the stock market. So more cash, increase the price to earnings ratio, which decreased the dividend yield. Earnings per share has gone up by 4.5%, partly due to increasing efficiency, but also because of buybacks. 11.9% has been the average over the last 10 years. Significantly higher than the last 73 years. Be interesting to see 1950 to 2013. I don't have it, but it'd be interesting to see that. I'm sure I could find it easily. So now we got to figure out what are we going to do next. All right. So right now, the dividend yield is 1.5, significantly lower than this, significantly lower than that. The headwind is going to be 0.5% on cash returns. So the Fed is forecasting cash returns, Fed funds rate, in excess of inflation. All right, so we have a low dividend yield and a headwind of cash. You can hoard cash and be rewarded now, whereas before you couldn't. I mean, you could hoard cash, but if you did, you'd be penalized because of inflation. So we're already two sheets to the wind, if you will. So then we got to look at PE ratios. Well, our PE ratios, which are already, let's just say 30, I don't know what they are, but they're already very, very high. I don't want to say historic high because that'd be 1999, but very high right now. Are they going to go up or go down? All right, so let's just assume PE ratios stay flat. All right, that 30 is high enough. People are like, yeah, I'm not willing to pay 35, but I still like stocks, so I'm not willing to sell it for a PE of 25. I'm just going to keep it at 30 or whatever it is right now. All right, let's just say PE ratios stay flat. All right, so for us to get this 11.9% rate of return we got over the last 10 years, we'd have to get, what's this? So 1.5 minus 0.5, that's 1. We'd have to get 11% on earnings growth year over year. 11%, because that'd be 12.5. Yeah, right there. So that's 12.5 minus 0.5, that's 12%, roughly what we got there. If PE ratios stay flat, we'd have to get 11% net of inflation earnings growth. And if you think that's happened, I got some oceanfront property in West Virginia for you. So what if PE ratios go down? All right, people are like, yeah, we've had a good run. I'm getting rewarded for holding cash. I'm going to take some gains off the table. The prices are pretty high as they are. I'm not getting really rewarded with a dividend right now. I'm going to take some gains off the table. Well, PE ratios went down 1% a year. All right, so now we got this is 1.5 negative, plus this 1.5. Now we got 0. That means earnings growth would have to be 12% a year. Yeah, 12% a year, net of inflation. I guess you could argue that, but that's not happening. So where's the returns going to come from? Let's say PE ratios increase by 5.5% a year, then earnings growth would have to increase by 5.5% a year. I guess it would have to be 12%. That's 11. Let's see. So that's 11, 12 point. Yeah, so right there. To get the 12% rate of return we've averaged over the last 10 years, if PE ratios, which are already very high, average 5.5% expansion each and every year, which I just don't see that happening. I mean, that's not happening. But let's just say it did. We still have to get earnings growth at 5.5% a year, which is more than double historical averages and still quite higher than we had for the last 10 years. I mean, where is that going to come from on cash buybacks? Your stock buybacks are going to increase their earnings per share by 5.5, which will get people more inclined to buy your stocks and increase the share price relative to earnings. Yeah, I don't see that happening. I mean, it could. I don't see it. So what do I expect? And I think this will drop by 1%. I think PE ratios will fall by 1% a year just because it's so high right now. And I think earnings growth, we'll just say 5% a year. All right, so here we got these two things wipe out that, so we get 5% a year earnings growth. That seems high to me too. I think it's going to be about 4% because that's going to be gross or net of inflation. I'm thinking 4% a year earnings growth. All right. So that's a 4% net of inflation rate of return on stocks. So, a third of what it was for the last 10 years, and a little bit more than a half what it was for the last 73 years. I'll take it though, man. That's a 4% rate of return on stocks, growth net of inflation. Bonds, a 10-year treasury is paying 4% right now. We'll say a 2% inflation rate or a 3% inflation rate. That's a 1% real return on bonds. That ain't much, but stocks are better. 4% rate of return on stocks are still better than a 1% real return on bonds or even a 2% real return on bonds. That's just what I see. So when you see the market start to decline, you say, okay, what does this do for my stocks? Well, it just makes them cheaper, which means there's more upside for the future. Now, for me, I'm only 53, so I'm still plugging, I think, $1,000 every 2 weeks into VTI, the Vanguard Total Stock Index. So the markets go like this. It doesn't matter because there's going to be a positive bias towards stocks. And I talk about this in my course, my investment course, the positive bias. Yes, markets do go down, but they tend to go up a lot more than they go down. No, that's what historically they have. Will they continue to do that? I don't know. But I think it's worth thinking that the earnings growth of stocks plus the dividend yields will beat inflation. Thus, there'll be a historical bias for sure. All right, so even though the stocks won't give us the 11.9% that we've had over the last 10 years, I don't even think they're going to give us 7.1% that we've had over the last 73 years. I think 4% is probably about what we should expect. And actually, I use a little bit less than that in my right capital. All right, so for stocks, I use a 6% gross rate of return plus about 3 to 3.5% inflation. So right capital, I'm using about 3 to 3.5%. That's how conservative I am in the right capital software I use. Anyway, it'll be interesting to see. Because the only way stocks outperform is earnings growth. That's it. Or increasing in PE expansion. PE expansion up to 60, okay, I don't see that happen where it's at right now. So the only way for stocks are an increasing PE expansion or increasing earnings growth. And I just have to say, where does earnings growth come from? Well, buy back shares. We've been doing that for the last 10 years, and this is what we got. So where else? It'll be interesting to see. Love to hear your thoughts. Put them in the doobie-dook. All right. And again, if you want to join us on Locals, we go live every Wednesday at 8 p.m. Eastern Time. Have a fun discussion with all the fellas and ladies. We talk lots of stuff. Talk politics, we talk sports, we talk dogs, we talk finance, and we just talk cool kid stuff because we're all cool kids. It's $5 a month is a doobie-doo. All right, let me hear your thoughts. We'll see you.